Well, the average investor should employ professional investors, and for us professional investors, this has been an exhausting summer.
Right.
A lot of volatility, a lot of uncertainty. It's the trade conflict is the root of things, but now at this point, substantial dislocations in interest rates. And what should the ordinary investor do? Our suggestion is it's time to take a defensive stance. We are uncertain, and we don't see enough upside to make the uncertainty worth the risk. And for this reason, we are looking at other asset classes that may not have the highest returns, but they're going to protect the capital until there's a more confident outlook. So we're looking at short-term interest rates, short duration. We're looking at municipal bonds, high-grade, investment-grade corporate bonds, and at equities. Although we've been champions of equities for quite some time, we think the only place in equities where the upside is warranted, is worth it, is bond substitutes,
right.
REITs, utilities, communications, tech software. We are batting down the hatches for what we think is a well-justified, let's call it correction. Far from a bear market, but markets need a 5 to 10% pullback from here.
And often that correction lasts a day until the next tweet or something. Samir, what about you? And I would add to the list of standouts where people have gone to the safety trade. Gold is at a multi-year high as well. Where do you think individual investors should be going, if at all? Again, is the question that they should just stay the course if they have a long-term perspective?
Bill, there is something to be said about staying the course, but at the same time, even, if you take the trade issue and set it aside, we're 10 years into this bull market. People have made a lot of money. So this is a good time to kind of be thinking about your overall risk exposure and not owning too much in equities, not being over your skis. Not only that, but, Kelly just had a great discussion about now you've got risk-free assets, right, where basically treasuries, German bonds are now low or even negative yielding. So you need to worry a little bit about, how much exposure do you have to those types of asset classes. David mentioned cash. We think that's probably a good spot to kind of park out for a little bit. But that's a melting iceberg, right? Because the Fed's going to keep chipping away at it and kind of cutting interest rates. So you probably do need to look towards alternatives, non-correlated strategies, things like, gold, REITs, utilities. We've added a little bit more back to some of those sectors. But again, we would be leaning too heavily there because you could easily have a buyer's strike where some of these yields, kind of snap back quickly.
Right.
It's not a great sign when we have market strategists tell us, cash is looking pretty good right now. David, let me pick up on, you mentioned a couple of areas of the market that are the richest parts of the market right now. So whether it's munis, corporate bonds, bond substitutes like REITs and utilities, as Bob highlighted earlier, I mean, this is where the performance has been. This is where they're already looking pretty rich.
It's where the performance has been. One of our views is that trends that have worked will continue to work. The growth stocks will continue to outperform the value stocks. Large cap will outperform small cap. U.S. will outperform most of the rest of the world. But look, the big trend, and the trend that may even have more to go, is this consistent decline in interest rates. And that makes many of the things that may appear expensive actually very reasonable. I'm not going to suggest that people chase dividends for dividends' sake. We want to make sure that those dividends are safe, those dividends are reliable. So our focus is more on defensiveness than it is on dividends at this stage. And yes, again, those would be those bond substitute sectors.
Right. And
muni bonds, corporate bonds, there are some spreads there, still some spreads left versus these risk-free yields.
Very quick question to both of you before we let you go. If you're advocating getting into those short-term bonds, you must believe that rates are going much lower from here. There are those who have posited that even our short-term notes could go to 0%. Samir, do you agree or not? Quickly.
We think the Fed probably will cut 2 more times this year, so those rates probably are headed lower. But again, in a relative standpoint, that's a pretty good place to park cash.
David?
We think the Fed will cut a couple more times, perhaps more, but unlikely to go below 1.5% on the Fed funds rate unless more signs of a recession. But the point is, short-term bond investing is about protecting capital, and that's our focus at this moment.